Okay, let's now move to another chapter which is on risk analysis and capital budgeting. A chapter which has a lot of computation to be done because it's a computation heavy chapter, but there are few areas only to be discussed. This is not a voluminous chapter, it is slightly lesser on the volume side. Now, in this chapter, you will learn first about how do you calculate expected NPV. Listen for some time. How do you calculate expected NPV? Expected NPV is the weighted average of various possible NPV with probability being the assigned weight. Second, you will learn about standard deviation where there is something called as independent cash flows and dependent cash flows. You will understand when we do it. Third concept you are going to learn about is RADR approach, CEF approach, and then finally you do something called a sensitivity analysis. So broadly limited concepts are there. Let's directly start with some problem solving. Let's come to question 1. Shivam Limited is considering two mutually exclusive projects A and B. Project A cost 36,000, project B 30,000. You have been given the following NPV distribution, project NPV probability, calculate expected NPV, calculate standard deviation, calculate profitability index, and which project would you recommend and why? Now, let me first explain this question. In this question, NPV has been given, probabilities have been given. The same type of a problem you may do in a second or third question where NPV may not have been given. You'll have to calculate NPV and then follow this approach. So we are required to calculate expected NPV and standard deviation. So there's a format to do this. Let's start. Working note 1. I'll do only one project. Computation of NPV and standard deviation. Computation of NPV and standard deviation. NPV and standard deviation. NPV probability. These are the two numbers I want, okay. If I have NPV and probability, I can calculate expected NPV and standard deviation. Everything can be calculated. NPV and probability as given in the question. NPV probability, product deviation, and PD square. Probability into deviation. NPV, probability, product, deviation, and PD square. This is the format we will follow. In that, NPV and probability either can be given directly or you will have to calculate. Important part is getting NPV and probability. This problem in short doesn't have anything because it's only calculator's job. There's nothing which you need to do in this question. The NPV given in the question is, I'll do it in thousands. If you do it as 15,000, when you square it, it will become 15,000 into 15,000, a huge number. So it will become difficult for you to solve. So in thousands, 15, 12, 6, 3, probabilities are given 0.2, 0.3, 0.3, 0.2. Probability is, understand the calculation. Let's not get into much of writing. I don't think so much of writing will help in this question. In this area at least, writing is not going to help because you will keep focusing on writing things rather than understanding it. Let the focus be on understanding stuff. Other areas at least it's not that voluminous. This is a hugely time consuming area from a calculation point of view. NPV into probability is product. NPV into probability is product. So I'll put a total because it will take you a lot of time to do the calculation. So let's not spend time on calculation. NPV into probability is product. Deviation is NPV minus sum of product. NPV minus sum of product. So 15 minus 9, 12 minus 9, 6 minus 9, 3 minus 9. And PD square is probability into deviation into deviation. Probability into deviation. Square is only for deviation. Probability into deviation into deviation. We put a total for this as well. Expected NPV is sum of product 9,000. Expected NPV is 9,000. Sum of your product. Standard deviation is square root of PD square. Square root of PD square. So I'll take a square root of this. And I'll multiply this with 1000, okay. Standard deviation is rupees 4,450. Rupees 4,450. That is the standard deviation. I've taken a square root, multiplied with 1000 because we did the problem in 1000. So your standard deviation is 4450. The problem is over. That's all. This is what this question wants you to do. It is more of a calculator's job. I can change the numbers for the second one and I can get to the answer. They've also asked for profitability index. This is more of the solving. Can you close the door? Profitability index, when you do profitability index, you will learn of more about this in investment decision. Profitability index is inflow by outflow. Inflow is NPV plus outflow. I'm not going to spend much time on this. This is something which you learn in investment decision. NPV plus outflow. NPV was 9,000, outflow was 36 by 36, some 1.25 times. 1.25 times, that's on the profitability index. The important part is this: NPV, probability, product deviation, and PD square. This is the format which will help you to calculate the expected NPV and standard deviation. Expected NPV is NPV into probability. You get the product, put a total of the product. That's called as the expected NPV of the project. Deviation is NPV minus the sum of the product, and PD square is probability into deviation into deviation. Any doubts on this? Let's get to question 2. A Limited is considering two mutually exclusive projects. You have been given the following net cash flow probability distribution of each project. Probability net cash flow 50,000, 60,000, 70,000. Expected net cash flow, variance, standard deviation, coefficient of variation. I'm not bothered about project Y. I'm just going to focus on project X. The only difference between this question and the earlier question is, earlier questions use the word expected NPV. This question is saying please calculate expected net cash flow. Expected net cash flow, and net cash flows are given in the question. So what I'm going to do is, I'm substituting here, okay? 50, 60, 70. The probabilities are given 0.3, 0.3, 0.4. The expected net cash flow is 61,000. The expected net cash flow is 61,000. Expected standard variance is 69, and your standard deviation is 8,307. Standard deviation is 8,307. So the same thing, instead of using the word NPV, they have used the word net cash flow. 50, 60, 70. The probabilities were given 0.3, 0.3 and 4. I have done a product of that. The total is 61. Let's ignore this part of it. Deviation, probability into deviation, the sum was 69. The sum was 69. So this is there. The only thing is, in variance you will have to do into 1000 two times, okay, because variance is a square. Variance is square, so you will have to do into 1000 two times. Your standard deviation is 8,307. Okay, I'll touch upon coefficient of variation. Now listen, coefficient of variation formula is NPV, the formula is risk per unit of return. This is the formula, okay. Risk is measured through standard deviation, return is measured through NPV. Coefficient of variation formula is standard deviation by NPV. This question, it is standard deviation by NCF, standard deviation by net cash flow. I have done only project X, I have not done project Y. Previous question also read only one project. Now last part of the question may ask you this. Now how do you select this? For example, if you look at the previous question, the NPV was 9,000. This also 9,000. The return is same for both. The return was same for both the project. But from a risk point of view, this was 4450. This is 3795. So what I do is, I will select a project which gives me lower. See, there are two types of people. There is a conservative investor and there is an aggressive investor. An aggressive investor is one who chooses higher return. Both the projects give same return, 9,000, 9,000. A conservative investor wants lower risk. So you will go ahead and select this project. Standard deviation is lower, return is same. Return is 9,000 but lower standard deviation. What you will see mostly is, the question will say return is 10,000, 12,000. Standard deviation is 4,000, 6,000. It's very difficult for me to select a project now. Why it is difficult? Because 10,000 and 12,000 return is higher here. Risk is lower here. So one person will say project A, another person may say project B. So what will get selected will depend on the riskiness of the investor, risk appetite of the investor. Certain people are not interested in taking risk. If you are not interested in taking risk, if you are a conservative investor, you will select project A. If you are an aggressive investor, you will select project B. Sometimes a rare scenario, this could be 6,000 and this could be 4,000. Then this is the best possible thing, because high return as well as low risk, high return as well as low risk. So obviously I go ahead with the second project. Okay, let's come to question 3. Project X and Project Y are under the evaluation of XY company. Estimated cash flow and their probabilities are as follows. Project X, investment of 70 lakhs in year 0, probability, cash flows. Project Y, investment of 80 lakh, probability and cash flow. Which project is better based on NPV? Compute the standard deviation and analyze the inherent risk of the project. Go through this. Okay, if I compare this with the earlier question NPV was given to you. They gave you 3 different NPV and then you calculated the answer. This question they have given the cash flows. If I compare with the question 1, they have given the cash flows, they have not given you the NPV. So how do we go about solving these type of problem is what you're going to understand. Let's come to project X first. When it comes to project X, for every year they have given the cash flow. For example, year 1 can be 30 or 50 or 65. Year 2 can be 30, 40 or 55. Year 3 can be 30, 40 or 45. For every year, you have to calculate NPV and standard deviation. For every year, you will have to calculate NPV as well as standard deviation. What is the use of standard deviation? You'll understand. So, NPV and SD of year 1. NPV and standard deviation of, sorry, not NPV, expected cash flow. Expected cash flow and standard deviation of year 1, same format. They have given the cash flows as 30, 50 and 65. 30, 50 and 65 for the first year. The probabilities are 0.3, 0.4, 0.3. The expected is 48.5. So expected cash flow is 48.5. Standard deviation of year 1 is some 13.61. You can just check the calculation if at all any error is there. 30, 50 and 65, 13.61 and 48.5. This is year 1. You have to repeat this for year 2. You will have to repeat this for year 2. Expected cash flow and SD of year 2. Year 2 is 30, 40 and 55. Expected cash flow is 41.5, standard deviation is 9.76. Standard deviation is 9.76. You will have to repeat this for third year. You will have to repeat this for the third year. SD of year 3, 30, 40 and 45. Once you get these 3 numbers, that is standard deviation for every year and expected cash flow for every year. You will have to calculate expected cash flow for every year and standard deviation for every year. I may have to repeat this for project Y also. One good part about project Y is year 1, year 2, year 3, all the 3 years the same number will be there, because they have not given separately cash flow for each year. They have given the same cash flow for all the years. They have given the same number for all the 3 years. So there, when you do NPV and standard, so when you do expected cash flow and standard deviation, you calculate for first year, the same will be for second year, the same will be for third year. That is as far as the project Y is concerned. Once we are done with this, computation of NPV, year, cash flow, PVF, DCF. This is the format you would have learnt as part of investment decision to calculate NPV. Year, cash flow, PVF and DCF. Three years. Year 0, the outflow of the project is 70 lakh. Year 1, we are earning 48.5. Year 2, we are earning 41.5. Year 3, we are earning 38.5. You will not be in a position to write this. Understand the calculation properly. Every year, what is the expected cash flow we have calculated. Every year, we have also calculated the standard deviation. Both have been done. Expected cash flow and standard deviation. What is the discount rate given in the question? 10%. 10%. And this is my NPV. I'm not going to spend any time on explaining this part of it. So what we did is for every year, we calculated the expected cash flow. We calculated the expected cash flow and calculated the weighted average of that, and then did this answer. This is the expected NPV of the project. Any doubts on this? Any doubts on the expected NPV? Next comes the standard deviation. This is slightly tricky. Computation of standard deviation. Year, standard deviation, discounted standard deviation square. What is the reason for square and all, you will understand. Year, standard deviation, PVF at 10%, discounted standard deviation, and DSD square. What is this DSD square? You will understand. Every year I had told you to calculate standard deviation. Every year we did a standard deviation calculation. First year the standard deviation was 13.61. Second year the standard deviation was 9.76. Third year the standard deviation was 5.94. Every year we had to calculate a standard deviation. Now you have calculated the standard deviation of every year. You cannot add them together. Standard deviation of year 1 is the first year value, then second year value, then the third year value. You need to discount them at that cost of capital, which is 10%, and this is called discounted standard deviation. Another thing is square of this. This is called discounted standard deviation square. You will do a square of this. See, one is you have the standard deviation, multiply with the PVF, that's called discounted standard deviation. Then there's something called as discounted standard deviation square. Now SD if cash flow are dependent, SD if cash flow are independent. There are two types of cash flow. Okay, what is dependent cash flow is if you get a bad year, you will continue to get a bad year. Dependent means if you start the project first year it is successful, it will continue to be a successful project. First year is bad, it will continue to be a bad project. This is a slightly riskier proposition. Dependent cash flow is risky because if you get a good year, you are happy, you will continue to get a good year. But if you get a bad year, you are gone, you will continue to have only bad years. Independent means 1 year could be good, second year could be bad, third year could be good, fourth year could be bad, fifth year could be moderate. So you will get a combination of it. You will get a combination. So independent is less risky. Independent is less risky. Dependent is more risky. Now what you need to do is, one of the answer is square root, because you took a square. Now you need to take a square root. See, DSD, then we squared it. I put a total of that. There is a total for discounted standard deviation. There is also a total for discounted standard deviation square. There is a total for discounted standard deviation. There is also a total for discounted standard deviation square. For the square, take a square root. One answer is 24.89 lakhs and another answer is 15.42 lakhs. Your independent is less risky, so it will have lesser standard deviation. Dependent is more risky, it will have more standard deviation. One answer is total of DSD, another answer is total of DSD square with a square root. Total of DSD square with the square root. So one answer is 24.89 lakh, another answer is 15.42 lakh. It all depends whether the cash flows are dependent or independent. Some question may even tell that. Some question may even go ahead and tell that. Just give me. Yeah. You have SD if cash flows are dependent 24.89 lakh, SD if cash flows are independent, which is a square root, you end up getting 15.42 lakh. It depends on whether the cash flows are dependent or independent. If the problem is silent, you will have to do both. When you repeat for project Y, when you do for project Y, the only thing I was saying is this 45.5 will be the same for year 1, year 2, year 3. Same 45.5 and same 3.5. It's not going to be different for different years because they have given only one number. So when you did standard deviation, see here, same 3.5 for all the 3 years. Same 3.5, DSD, DSD square, sum of DSD, square root of DSD square. Sum of DSD and square root of DSD square. Let's look at question 4. Jet Airways is planning to acquire a light commercial aircraft for flying class clients at an investment of 50 lakh. The expected CFAT for the next 3 years is year 1 CFAT and probability, year 2 CFAT and probability, year 3 CFAT and probability. Company wishes to take into consideration all possible risk factors relating to an airline operation. Company wants to know expected NPV with a 6% discount rate. Possible deviation is standard deviation if cash flows are independent and if cash flows are dependent. I'm not going to do the question, but I'm just going to explain it here. This question we are not going to do. If you look at this question, it's exactly same as previous question. It's exactly same as previous question. There is going to be a variant of this question which I'll explain in some time. Here what you will do is year 1. What you need to do is calculate expected NPV and expected cash flow and standard deviation. Year 2 expected cash flow and standard deviation. Year 3 expected cash flow and standard deviation. For NPV calculation, year, cash flow, PVF at 6%, DCF, the cash flow is the expected cash flow which you calculated. Standard deviation they are asking both. See here, cash flows are independent, cash flows are dependent. So when you do standard deviation, there will not be a year 0, it will start with year 1. Year, standard deviation, PVF, discounted standard deviation and DSD square. Discounted standard deviation and DSD square. Total of discounted standard deviation is dependent answer. DSD square total square root is independent. DSD square total square root is independent. Any doubts on this? We are going to see a variant of this now. This is the dependent cash flows are considered to be riskier. In this case, a weak cash flow will always be followed by a weak cash flow. Good cash flow will always be followed by a good cash flow. The problem is, if I get into a weak cash flow, I will be suffering continuously. I'll be suffering continuously. Whereas if it's independent, you have a hope for recovery. You have a hope for recovery. Good, bad can keep happening. Go through 5. Go through 5. I'll explain the variation which is going to be there in this question. Go through question 5, please. Okay, now listen. I have an initial investment of 1 lakh. Every year the inflow can either be 20,000, 30,000 and 40,000. Life is 5 years, salvage value, everything is given. if I go back, it is similar to this question. Every year the same cash flow is there. Every year the same cash flow was there in that problem also. In that problem also, they said either it can be 40 lakhs, 45 lakhs or 50 lakhs and the probability were given. They did not use the word best to worst or something, those wordings were not used. But it's similar to this question. If you look at this question, the requirement was standard deviation and which project is better. If you look at this question, they want us to calculate worst case NPV, best case NPV, probable NPV. The question is asking for some worst case NPV, best case NPV. When a question asks for worst case NPV or best case NPV, what you are required to do is, for every cash flow you will have to separately calculate NPV. For every cash flow you will have to separately calculate NPV. Once you get the NPV separately for every cash flow, from there on, if you want standard deviation, you can calculate. If you want standard deviation thereon, if the question says also calculate standard deviation, question says also calculate NPV, all that is possible. I go back to question 1. If you remember, in question 1 what happened is they gave you different NPV, different probability. So what we are going to do is, first we will convert this question like question 1. We are going to convert this question like question 1. What is there in question 1? NPVs were given, probability were given. So 1, you will calculate an NPV using this 20,000. Second, you will calculate an NPV using this 30,000. Third, you will calculate an NPV using this 40,000. Once you get 3 different NPV, it becomes like problem number 1. It becomes like problem number 1. Why am I calculating 3 different NPV? Why not follow the approach which we followed earlier? What did we do earlier? We calculated the standard deviation of cash flow and NPV of cash flow. You can follow that approach also in this question, but you will not be able to answer what is worst case NPV, what is best case NPV. You will not be able to answer what is the worst case NPV and what is the best case NPV. What is worst case, best cases? You will have to give different answers. You need multiple NPVs. For example, this question 1 which we had 4 NPVs in the question. So I can say best NPV is 15,000, worst NPV is 3,000, the probable NPV is what you had calculated. So all that is possible. If I tell you to give me the best case and worst case for question 2, you cannot give because you did not follow that approach. Sorry, question 3. In question 3, what you did is you calculated your final NPV can be either you calculate different NPV and then take a weighted average, or you take a weighted average of cash flow and calculate one NPV. It's your wish whether you want to take weighted average of cash flows and get one NPV as an answer, or calculate NPV and then take a weighted average. Both will give you the same answer. Answer is not going to be different. The only issue is this approach which I said in the earlier question will have to be followed if they ask you standard deviation and they say dependent cash flow and independent cash flow. If the question uses these wordings, you will have to follow what I said earlier. If the question asks you to calculate best case NPV and worst case NPV, best case NPV and worst case NPV, I am not doing this part of the answer. This is the one NPV, this is the second cash flow, this is the third cash flow, and I get 3 NPVs. Okay, so the NPV can be negative 40,180, the NPV can be negative 2,230, the NPV can be 31,700. I am not doing this part of it because you know how to calculate NPV. Here cash flow, in cash flow I have split into 3 different scenario. PVF, DCF also have split into 3 different scenario. Once you get this, you go back to question 1. You go back to question 1. What did the question 1 do? Question 1 had given the different NPV. Question 1 and also given the different probability. For example, if I go back to question 1, this is what you are done in question 1. In this I am going to write minus 40.18, minus 2.23 and 31.70. 31.70. The expected NPV is 0.1, 0.7, 0.2. The expected NPV is only 761. Not sure whether the numbers are right. Okay, yeah, number seems to be right. The expected NPV is only 0.76 thousand. The expected NPV is 0.76, and if you want standard deviation, that's also possible. Just give me a minute. The standard deviation is 19,113. The standard, exactly the same approach, okay. In that question, you had NPV and probability given. This question, the NPV and probability were not given. Once you get NPV, probability, do product, do deviation, do PD square. Product total will give you the expected NPV. Square root of PD square will give you the standard deviation. The only headache is if they say dependent, independent, that and all I cannot handle here. Dependent NPV, independent NPV and all we cannot handle in this format. If you want dependent, independent, then you will have to calculate individually every year standard deviation, individually every year expected cash flow, and then follow that format, which is year, standard deviation, PVF, DSD, DSD square. So this format can give you only one standard deviation. It cannot give you two standard deviation. It can only give you one standard deviation. Any doubts on this? Any doubts on this? Let's look at the requirement of the question. Probable NPV is this 0.76. Probable NPV is 0.76. Worst case is negative 40,180. Worst case is negative 40,180. Worst case is the lowest NPV. Best case is 31,700. Positive 31,700. State the probability of occurrence of the worst case if the cash flows are perfectly positively correlated over time. Now listen, they will ask you for probability saying two types of cash flow. One is correlated. Correlated means dependent. Correlated means dependent. Second type of cash flows are not correlated or independent. Not correlated or independent. Worst case, the probability of worst case is 0.10. The probability of worst case is 0.10. Listen, if they are perfect correlation, answer is 0.10 or 10%. Answer is 0.10 or 10%. The probability of that was 0.10. I have directly written that. If they are independent, listen, if they are independent, first year has to be bad, second year has to be bad, third year has to be bad, fourth year has to be bad, fifth year has to be bad. If they are dependent also, first year, second year, third year, all year have to be bad. But the problem is independent, once the first year is bad, second year will only be bad, third year will be bad, fourth year will be bad, fifth year. So if it's independent, first year bad is 0.10, second year bad is again 0.10, third year bad is again 0.10. Fourth year bad is 0.10, fifth year bad is 0.10. It's like that when you toss 5 coins, all the 5 coins should be head, which is 1 by 2 into 1 by 2 into 1 by 2 into 1 by 2 into 1 by 2. So if it's independent, the probability is 0.10 into 0.10 into 0.10 into 0.10 into 1.10. It will be a very insignificant number because independent means all 5 years will not be bad. That's the lowest possibility. That's the very rare possibility that all 5 years will be bad, and that probability is 0.10 power 5. 0.10 power 5. Whereas if it's dependent, first year bad is 0.10, second year bad is into 1 into 1 into 1, because once it is bad, it's always bad. Once it's bad, it's always bad. So here also joint probability only 0.10 into 1 into 1 into 1 into 1, because if you get a bad year, you will continue to get a bad year. So first year 10% chance of a bad year, second year 100% chance. If you get a bad year, it's only a bad year after that. So 0.1 into 1 into 1 into 1, it becomes 0.10, and this is I think 0.0001. So it will be a very insignificant number because 0.10 power 5. Clear? Able to understand this? Any doubts? Two types of cash flow: dependent, independent. Dependent are considered to be more risky. Dependent are considered to be more risky, and the probability of the worst case is 10% there. Probability of the worst case is 10%. Independent is less risky. The probability is also lesser. Okay, next approach is RADR, risk adjusted discount rate. I've discussed on NPV and standard deviation. Again, I'm repeating. One NPV could be given in the question. You do NPV, probability, product, deviation, PD square, and be done with the question. Cash flows could be given in the question. If they give cash flow, calculate expected cash flow and standard deviation for every year. Expected cash flow will give you NPV, standard deviation year, standard deviation PVF, DSD, DSD square will give you the standard deviation. This approach, but they want best case, worst case and all in the question. Then first calculate NPV for the given cash flow, go back to question 1 format and complete the solution. Next is RADR approach, risk adjusted discount rate. Now what does RADR approach says is that you can have multiple projects. Now all projects do not carry same risk. Some projects have higher risk, some projects have lesser risk. So you cannot say that you'll have to use the same discount rate, because what normally companies do is they'll say my cost of capital is 12%, use 12% as the discount rate for all projects. But some projects carry more risk, some projects carry less risk. So using the same discount rate for all projects is not logical. So under RADR approach, we are going to use different discount rate for different projects. Calculation of NPV is simple: year, cash flow, PVF, DCF, but the discount rate can be different for different projects. Let's look at question 6. ABC is evaluating 3 projects, P1, P2, P3. Following information is available: particulars, cost, inflow of year 1, year 2, year 3, year 4, risk index. Minimum required return of 15%, applicable tax rate is 40, risk free rate is 10%. Find out the RADR, risk adjusted discount rate. Which project is the best? Now, some question will give you directly the risk adjusted discount rate, some question may give you risk index, some question may give you coefficient of variation. Different ways are there. Coefficient of variation can also be given. Working note 1, computation of RADR. Working note 1, computation of RADR. RADR is equal to in this question RF plus beta into RM minus RF. RF plus beta into RM minus RF. RF plus beta into RM minus RF plus beta into RM minus RF. Project 1. The risk free rate would have been given in the question 10. Beta means risk index. Beta basically means risk index here, 1.8. RM means the normal rate, 15% minus 10. 10 plus 1.8 into 15 minus 10. RF plus beta into RM minus RF. 10 plus 1.8 into 15 minus 10. If your risk index is more than 1, it's a riskier project. Risk index less than 1, it's less riskier project. 10 plus 1.8 into 15 minus 10, how much you get? 19%. Project 2, 10 plus 1 into 15 minus 10, 15% as it is. 10 plus 1 into 15 minus 10, 10 plus 1 into 15 minus 10. Project 3, 10 plus 0.6 into 15 minus 10. 10 plus 0.6 in 13%. I am not doing beyond this. You have the cash flow. You will have to use the discount rate, year, cash flow, PVF, DCF, and whatever NPV you calculate, that's called as risk adjusted NPV. That's technically called as risk adjusted NPV. So this is discounted at 19%. Second project is at 15%. Third project is at 13%. You are going to use different discount rate for different projects. An enterprise is investing. Let's come to question 7. An enterprise is investing 100 lakhs in a project. Risk free rate of return is 7%. Risk premium expected by the project is management is 7%. Life of the project, following are the cash flow. Calculate NPV based on risk free rate and also on the basis of risk adjusted discount rate. Go through the question. Okay, I have year, cash flow, PVF, DCF. Year and cash flow are directly given in the question. They want you to calculate 2 NPV. One is based on risk free rate. Risk free rate means discount at 7%. Risk free rate means discount at 7%. Based on RADR means 7 plus another 7, discount at 14%. 7 plus another 7, discount at 14%. You will get to the same approach. Year, cash flow, PVF, DCF. The NPV will obviously change. 7% will give a higher NPV. 14% can give a lower NPV because you are increasing the discount rate. So this is discounted 7%. Then you are discounting it at 14%. Then you are discounting it at 14%. 7 plus another 7, 14% is the discount rate. Question 8. Okay, there's nothing much on this question. Invest Corporation Limited adjusts risk through discount rates by adding various risk premium to the risk-free rate depending on the resultant rate. The proposed project is judged to be a low, medium or high risk project. Risk-free rate, risk premium demonstrate the acceptability of the project on the basis of risk adjusted rate. Now, this question basically what they are saying is, if you are a low risk project, read it and let me know. If you are a low risk project, what will be the discount rate? Low risk project, what should be the discount rate? Read that table and tell me. Low risk project means what should be the discount rate? 8 plus 4, 12. Low risk means risk is still there, but I need 8 and extra 4. High risk project means what should be the discount rate? 18. Medium risk is 15. Medium is 15, high is 18. Now you need to assume some cash flow, random cash flow, and calculate NPV and then say how the project gets accepted at different levels of risk. This I don't see getting tested in exam. This is just an assumption. Any assumption can be taken. The cash flows were selected in such a manner that low risk project will get accepted, medium and high risk will get rejected. I selected the cash flow in that manner. It may not get tested mostly in exam, but basically you assume some cash flow and calculate NPV and say that the NPV will keep changing based on your discount rate. Okay, let's come to 15. Determine the risk adjusted NPV of the following projects: XYZ, outflow, life, inflow, coefficient of variation. Company selects RADR on the basis of coefficient of variation. Coefficient of variation, RADR, present value factor 1 to 5 years at RADR. Go through the question and tell me what should be the discount rate for X, Y and Z. You go through this for a minute and tell me what should be the discount rate for project X, what should be the discount rate for project Y, what should be the discount rate for project Z. X is what rate? 16%, Y 14%, Z is 12%, and based on that you calculate the NPV. RADR approach basically talks about different discount rates for different project. Now what they can end up doing is they may not give this in question. Coefficient of variation may not be given. Then you may have to calculate coefficient of variation as standard deviation divided by NPV or standard deviation of cash flow by expected cash flow. Some number could be given in the question. They'll give you some number to calculate this. After that is calculated, you get the RADR and then be done with the question. Okay, I'll take a break of 45 minutes. We'll take a lunch break now and we'll resume after that. There's some part of this still pending and then we'll do dividend decision. After this.